Welcome to Talk Tickers, the deep dive, where we really try to cut through the noise of earnings calls and distill what truly matters for you.
That's the goal.
Today, our focus is the Q3 2025 results for Amundi, the big European asset manager.
Right.
And our mission here feels pretty critical. Amundi delivered, strong operational beats, hit record asset levels.
Yeah, it looked great on paper.
Exactly, yet the stock just tanked, dropped more than 6% right after the announcement. So we need to separate, the fundamental value from what looks like market panic.
That 6% drop really is the headline, isn't it? And it creates this classic investor paradox. How does a company beat consensus on, nearly every major metric and still get punished like that?
Yeah.
So we need to start with the scorecard, look at the numbers, and then dive into that deep structural risk that clearly spooked the entire street.
Okay, let's do it. Starting with the hard numbers. The core financials, they were undeniably strong.
No question.
Amundi reported adjusted earnings per share, or EPS, of 1.65. That was a solid euro 0.09 beat over the 1.56 analyst consensus.
Decisive beat there.
And net revenue, 815 million. Again, significantly ahead of the 791 million expectation. That's 4.9% year-over-year growth?
Pretty healthy growth in this environment.
Adjusted net income landed at 340 million, so numbers look good.
And critically, for an asset manager, they're just swimming in client money right now. They reached a record high in assets under management, AUM we call it, hitting 2.317 trillion.
A record high, wow.
Yeah, and the pipeline looks healthy too. Q3 net inflows were 15.1 billion, which actually edged out the 14.4 billion consensus.
Yeah.
These are real quantitative wins, setting records in what's still a pretty tough environment.
Okay, so if the numbers were green, like across the board, why the really aggressive market skepticism? If the company is fundamentally strong, is the market just overreacting here?
Where do they spot a flaw?
Right. Is there a flaw so critical it just negates all that record performance? We need to look beyond the immediate P&L, I think, and really focus on this distribution risk everyone's talking about.
Absolutely. But look, before we get to the fear, we really have to establish the engine that's generating all this growth.
Yeah.
Because that gives us the floor valuation, right? Management emphasized their strategic growth pillars are, firing on all cylinders.
Please, Char.
Asia, third-party distribution partners, and especially ETFs, exchange-traded funds. Combined, these areas brought in 55 billion of the total 67 billion year-to-date inflows.
55 out of 67 billion. That's huge.
It is. That isn't just growth. That's diversification delivering real scale.
And the passive investing side, the ETFs, that momentum sounds pretty incredible.
Oh, it's breathtaking. Amundi's ETF segment, which is, highly scalable, it officially crossed the 300 billion AUM mark this quarter.
300 billion.
Yep. And that performance firmly cements them as the second largest player in the European ETF market. That's by both assets and inflows.
So they're really gaining share.
They are. And they specifically called out the success of flagship products like their core S&P 500 swap and the core stocks Europe 600 ETF. Those are major drivers. This is high margin, sticky business, and frankly, less staff intensive too.
Right. Scalable.
Exactly. And that focus on low-cost scalability, it actually extends to their technology segment as well.
Amundi Technology.
Right. The platform they use internally, but also license out to others.
Yeah.
It's now a significant diversifying revenue stream. That revenue hit 81 million year to date.
Okay.
Which marks an impressive 48% year-over-year increase.
48%? Wow.
Yeah. This platform strategy offers, critical resilience. When traditional management fees get pressured by market swings or interest rates, this recurring tech licensing revenue acts as a kind of stabilizer.
That makes sense. And this growth, it's backed up by serious cost discipline too, right? Can we walk through those efficiency metrics?
We can. Management showed a really strict approach to operating costs. They reported an adjusted cost-to-income ratio of 53.5% for Q3. Year to date, it's 52.8%.
Okay, 52.8% year to date. What does that mean for the listener?
Well, to translate that for you, a 52.8% ratio means that for every euro of revenue they earn, only about 53 cents goes toward operating costs. That is a tight, disciplined figure. Shows excellent leverage.
And they're actively managing that cost base, not just sitting on it. They're planning for future growth.
They are. Look, they booked an 80 million restructuring charge in Q3. Now, that might sound bad, but this isn't really a cost burden. Think of it as an investment.
An investment? How so?
That charge is designed to generate 40 million in annualized savings starting in 2026. And management was very clear. Those savings will be immediately reinvested into expanding those high-growth areas we just talked about, technology, ETFs, Asia.
Okay, so efficiency and growth plans are there, but client retention, it always hinges on performance, doesn't it? What's the track record telling us?
It's stellar, actually. Amundi reported that 82% of their AUM outperformed their respective benchmarks over a 5-year period.
82% over 5 years.
Yeah. In the highly competitive world of active management, sustained strong performance like that is, well, it's the absolute bedrock of client trust and retention. You have to deliver.
Okay. Now, before we move to the risks, there's one unique differentiator that kind of stood out to me. It feels strategic because it gives them a distribution channel they actually control.
You mean their French employee savings and retirement business?
Exactly.
Yeah, what's fascinating here is that this division manages $101 billion, and it commands a massive 45% market share in France.
45% market share.
Huge. And this isn't just another line item on the P&L. This is really the only business where they have direct B2B2C access, business to consumer access to 4 million end clients.
4 million clients
Directly. They own the entire ecosystem, the platform, the servicing, the digital tools. This is a real structural advantage that, partially insulates them from the very third-party distribution volatility that's causing all this current stock panic.
Okay, wait. So if the core business is truly this strong, with record AUM, soaring tech and ETF growth, this huge controlled channel in France, then why did the market panic over just 4% of AUM?
That's the multi-billion euro question, isn't it?
Is the market missing something obvious, or is that 4% just far more toxic than it looks on the surface?
Let's cut to the chase here. We've got 2.3 trillion in AUM, but still a 6% stock drop. The uncertainty, the thing that caused the market collapse, it's almost entirely related to the UniCredit distribution agreement.
Right, the big Italian bank.
Exactly. This partnership, it's like the investment management equivalent of a massive client contract expiring. It's this giant ticking clock the market just can't ignore. And it's set to run out in July 2027.
Okay, so let's quantify that risk. Explain why it's so critical.
Right. So UniCredit represents 88 billion in AUM. That's roughly 4% of Amundi's total assets. Now, 4% might seem manageable, right?
On the surface, yeah.
But here's why it's toxic, as you put it. These are primarily high-margin active mandates. Amundi estimates the revenue margin on this specific chunk of business is around 40 basis points.
40 basis points, so 0.40%.
Correct. 0.40% of those assets generate revenue. Now, that is significantly higher than the firm's overall average margin, which gets diluted by all those low-margin passive products like ETFs.
Okay. So losing that specific revenue stream would hit the bottom line much harder than losing an average 4% of AUM.
Precisely. It's because of its premium margin profile. That's the worry.
And the market hates ambiguity, doesn't it? Management was pretty upfront about the potential cliff risk here.
It had to be, really.
Yeah.
They acknowledge that in an unfavorable scenario, like if the partnership isn't renewed or renegotiated on good terms, the largest chunk of those assets could just walk out the door within 2 years after expiration.
2 years.
Yeah. So that creates a very defined high margin revenue cliff. And the market, well, it often prices in like 80% to 90% of a worst case scenario the minute it's confirmed. Bang.
Okay, so that's the context that explains the stock drop. It makes more sense now. But management also gave a clear response to this structural uncertainty, right? They're basically committing to a future where UniCredit is optional.
That's the entire story for the next, 3 years?
Exactly. They announced their new 2028 strategic plan. It's coming up soon, November 18th, 2025. And they said it will explicitly bake in this uncertainty.
Bake it in how?
Their commitment is to deliver targets that are achievable regardless of the UniCredit outcome, whether they keep it or lose it. This is the official signal, that they're transitioning towards a partner-agnostic growth model.
Okay, for the listener, what exactly does partner-agnostic mean for a company of this scale? What does that look like in practice?
It means they're signaling, pretty clearly, increased investment into distribution channels they control themselves.
Like the tech platform. Yes. Exactly. Scaling up their technology platform licensing, ramping up direct third-party distribution that isn't tied to major banking partnerships. It means relying less on these big legacy bank networks.
Oh, like UniCredit.
Like UniCredit, and relying more on M&A, maybe, or organic growth in areas they fully own, like ETFs and their push into Asia. The key thing is, that November 18th strategy day needs to prove, with hard numbers, that those high-growth pillars can actually absorb the potential loss of that high-margin UniCredit revenue.
Okay. Big day coming up. Now, let's quickly touch on the other large outflow that made headlines, the one related to the India EPFO mandate managed by SBIMF. We need to distinguish this clearly from the UniCredit risk, right?
Oh, absolutely. Vital distinction. Look, Amundi is expecting a significant AUM outflow in Q4, somewhere between 30 billion and 40 billion, as that specific mandate gets reallocated.
That's a huge number, 30 to 40 billion.
It is. And when you see a 40 billion outflow headline, it's naturally alarming. However, and this is the crucial context management, provided this specific massive outflow will have a negligible revenue impact.
Negligible revenue impact. Why?
Because those assets were ultra low margin. They were basically held for scale, not for profit.
Yeah.
So the market often reacts just to the huge AUM flow numbers. But a savvy investor, you look only at the revenue and the margin tied to those assets.
Got it. So UniCredit is the revenue risk. The India mandate is just a scale reduction, no real financial consequence.
Precisely. Very different situations.
Okay. And finally, on the context side, we should probably note the macro headwinds that dampened the overall AUM growth picture a bit, even if it wasn't an operational failure.
Yeah, good point. They reported a negative currency effect of 87 billion on AUM just year to date.
87 billion wiped out by FX.
Yeah, driven primarily by the depreciation of the US dollar, down 11% against the euro, and the Indian rupee, which was down 15%. So while they're still at record AUM, that's a massive drag on the reported number purely because of how currencies translated back to their euro balance sheet.
Okay. Let's quickly wrap up capital allocation then. Do they have the dry powder to actually execute this partner-agnostic strategy? Can they invest their way out of this?
Seems like it. They confirmed their excess capital position remains close to 1.3 billion.
1.3 billion euros.
Yeah. Their primary priority, they said, is value-creating M&A to accelerate those new growth pillars we've been discussing. But importantly, management confirmed that if suitable M&A deals don't materialize, they are highly open to returning that excess capital to shareholders.
Okay. So buybacks or special dividends could be on the table.
Could be. But the decision on a special distribution or maybe a larger buyback program, that's also been deferred until that critical November 18th strategy day. Everything seems to point to that date.
Okay, that gives us a really complete view of the quarter, I think. Strong engine, very clear risk, and this high-stakes plan to try and neutralize that risk. #tag, this is not financial advice segment. All right. Now for the segment based on our analysis of these earnings called transcripts. And remember, this is purely for discussion, for informational purposes. It is absolutely not personalized investment advice. You really need to consult a qualified financial professional before taking any action.
Definitely. Standard disclaimer applies. So we've established the core tension here, right? You've got this structurally strong asset manager accelerating diversified businesses, but it's currently being held hostage, essentially, by a contract representing only 4% of AUM, but a much bigger slice of that high margin revenue.
Okay, so my thesis here is pretty simple, actually. I think the market has already priced in a significant percentage of the worst-case UniCredit revenue loss. That big stock drop, it reflects this binary fear, this on or off fear of the contract expiring.
While ignoring the good stuff.
Exactly, while simultaneously ignoring the verifiable accelerating operational value we just spent the last 10 minutes detailing.
Okay, so given that setup and the timing, what's the outrageous but plausible trade idea?
Well, look, how about taking a conviction long position on Amundi shares, leading directly into that November 18th strategic plan day?
Buying the dip ahead of the news.
Essentially, the bet is that the stock is currently trading based almost entirely on this single high-profile counterparty risk. We're betting that the floor, the fundamental value established by that 300 billion ETF segment and the 48% growth in technology revenues, that floor is solid.
So you're betting on the strategy day itself, betting that management delivers a plan with concrete numbers that basically neutralizes the fear.
Precisely. We buy the dip now. The market is just waiting. It's waiting for that strategy day like it's waiting for a judge's ruling or something. If management provides credible, conservative, and truly partner-agnostic 2028 growth targets, which they've strongly signaled they will do, then the market will be almost forced to re-rate the stock.
Forced to look at the core business again.
Right. Forced to value it based on its robust core asset management engine rather than just pricing an expiring contract. We're basically betting on the strategy removing that UniCredit discount before the year is out.
A fascinating, high-conviction, pre-catalyst play. But it's contingent entirely on management's ability to communicate a really clear, actionable, and believable plan on November 18th. High stakes.
Definitely high stakes. So to wrap this all up, Amundi's Q3 was fundamentally a structural success. They hit record AUM, delivered strong operational performance, especially in those chosen growth areas like ETFs and tech.
Oh,
But the entire market narrative right now is being held hostage by the medium-term uncertainty surrounding that high-margin UniCredit distribution agreement.
and the most important date on your calendar, if you're following the stock, it remains November 18th, 2025. That strategic plan presentation is going to determine whether the market finally moves past this current risk discount and fully acknowledges the underlying resilient value of their platform, their technology, and that passive momentum.
So here's a final question for you, the listener, to reflect on. Given that the stock seems to be moving based purely on the potential loss of a high-margin contract rather than its current fundamental performance, are you valuing a strong, diversifying asset management engine, or are you simply pricing the fear of an expiring contract?
Something to think about. We encourage you to dig into those strategic pillar results yourself.
Thank you for joining us for this Talk Tickers deep dive into the Q3 2025 earnings for Amundi.
As always, the information discussed here is for educational purposes only. Please consult a financial professional before making any investment decisions.
We'll see you next time.